Hi, thank you for watching Digging to China. I'm Dong Shang. If you have not done so already, please subscribe to my channel. Thank you very much. The Chinese Communist Party released the macroeconomic data for the first quarter on April 18th, which was unusual and rare in recent years. The CCP announced that the GDP growth in the first quarter was higher than expected and the situation was very good. However, National Bureau of Statistics officials spent a considerable amount of time emphasizing that China's economy was not as bad as it seemed. In previous years, officials were proud to explain good data citing factors like Xi Jinping's leadership. But this year, they focused on explaining that our economy is not as bad as you think. We are still doing well. This contradictory explanation suggests officials cannot be happy about the good data and are insecure about it. China's National Bureau of Statistics conveyed 6 pieces of key information about economic data in the first quarter of this year during their high-profile information release conference. Firstly, let us gain an understanding of what kind of information was released by China's National Bureau of Statistics. The first piece of information, and undoubtedly the most significant one, is that the GDP growth in the first quarter was much higher than expected, at 4.5%. This is a significant increase compared to the market's expectation of 4%, making it a very positive data point. Standard Chartered Bank wasted no time and promptly announced an increase in its forecast for China's full-year GDP growth in 2023 from 5.5% to 5.8%, reflecting a highly optimistic outlook. U.S. banks are equally bullish, with Citibank announcing an upward revision of China's 2023 economic growth target from 5.5% to 6.1%, showcasing their strong confidence in the Chinese economy. The second piece of information is less encouraging, as it reveals that China's government fiscal revenue only increased by 0.5% in the first quarter, despite the GDP growth of 4.5%. This is a strange occurrence because the primary source of revenue, the general public budget income mainly based on taxation, dropped by almost 5%. However, non-tax revenue, including various government fees, increased by 10%, leading to an overall increase of 0.5%. One news story that sparked widespread discussion involved the farmers in Hebei or Heilongjiang province being fined over 10 billion yuan for burning wheat stalks. The government relies on such arbitrary fines since tax revenue has declined significantly, and the only other non-tax revenue source, the land sales, also decreased in the first quarter. As a result, this 10% revenue increase solely stems from the government's fines, with the central government having some income from state-owned capital, while local governments have limited access to this source of revenue. During the first quarter, there was a significant increase in local securities issuance, more than 1.3 trillion yuan. The central government provided the local government with over 1.3 trillion yuan by printing money. This indicates that China's fiscal system is highly dependent on such measures and lacks source of revenue and taxation. Despite weak corporate performance, the government is relying on non-tax revenue to maintain a growth rate of just 0.5%. This is the second reason why the director of the Statistics Bureau is not satisfied. The third important piece of information, which also does not please the director of the Statistics Bureau, is the unemployment rate in March. Although the surveyed unemployment rate has slightly decreased to 5.3%, the youth unemployment rate has increased from 18.1% to 19.6% in March. The youth unemployment rate includes people between the age of 16 and 24 who represent the main part of the labor force growth. Unfortunately, their unemployment rate did not decrease with the overall unemployment rate, but has instead increased. This data contradicts the notion of a booming economy. A youth unemployment rate of almost 20% is a significant concern. For comparison, the US has a youth unemployment rate of only 5%, and in countries with relatively strong economies like Germany, the youth unemployment rate is less than 10%. In contrast, in some of the worst performing countries in Southern Europe, their youth unemployment rate is also close to 19%. Consequently, this unemployment rate cannot support a 4.5% GDP growth. In the first quarter, the per capita disposable income of Chinese residents across the country was 10,800 yuan, with a nominal growth of 5.1% and a real growth of 3.8% after adjusting for price factors. While this data was not accompanied by statistic basis, it is still regarded as positive news by the director of the Statistics Bureau. The fifth piece of information is also causing concern for the CCP. Real estate development investment in the first quarter decreased by 5.8% compared to the same period last year, which is a significant decline. Despite the party's efforts to stimulate the industry by investing heavily and implementing measures such as lowering interest rates and providing loans, investment has still decreased. This is a major problem, as real estate is a crucial indicator of the Chinese economy's health. Furthermore, there was a 1.8% year-on-year decrease in the total area of residential housing sales in the first quarter. Therefore, this data is quite negative and is causing a headache for the Communist Party. The head of the Statistics Bureau is required to clarify the sixth aspect of information, which indicates that although the GDP growth appears high, tax revenue has decreased, fiscal revenue has remained relatively unchanged, and an unemployment rate is rising. As a result, there are rumors in society that China is facing deflation, causing immense pressure on the head of the Statistics Bureau. Despite this, he spent a significant amount of time explaining that the economy is not as bad as it seems. China has not yet experienced a deflation, according to spokesperson Fu Linghui, who stated that deflation is commonly defined as a sustained decrease in the overall price level, often accompanied by a reduction in the money supply and economic recession. He went on to explain that with China's significant increase in money supply, it does not meet the definition of deflation. However, despite the expansion of M2 and the currency issuance, most of the new money has not been invested in the real economy, but rather in the government's local debt, which is referred to as borrowing new money to repay old debt. Although the National Bureau of Statistics claims that printing more money will prevent deflation, the explanation is unconvincing. It is challenging to obtain reliable data to determine whether or not China has entered deflation. Nevertheless, the overall impression of China's macroeconomy is not as good as the 4.5% GDP growth suggests. Despite exceeding expectations in GDP, officials from the Statistics Bureau are not content, and they are hesitant to draw any conclusions about the state of the economy. It is uncommon to have information released from 6 different aspects, and the data presented are often contradictory. Despite the presentation of positive data, there is a prevailing sense of pessimism, which is also a rare phenomenon. Here is my takeaway. It is really time to focus on China's local government debt, which has recently become a popular topic on Chinese social media, particularly with Guizhou's plea for assistance from the central government. The province has stated that it is unable to solve its local debt problem, even with more borrowing, due to its inability to sustain such a massive debt. This case highlights the severity of China's local government debt situation, which could ultimately affect its macroeconomic situation and potentially lead to economic collapse. Guizhou province's situation is particularly concerning, given that it has been one of the fastest growing provinces in terms of its economy, but also one of the provinces with the fastest growing debt over the past decade. According to the China local government debt financing platform, Guizhou's local debt amounted to 1.19 trillion yuan in 2021, which is close to the warning line for debt set by the Chinese government at 1.24 trillion yuan. This means that Guizhou needs to pay back 180 billion yuan every year for principal and interests. The extent of China's local debt problem is unclear, as the government has not been forthcoming about the actual situation. While the official data shows a total debt of $9 trillion, equivalent to 61.5 trillion yuan, this is a shrunken version of the actual debt, with internal sources indicating that the debt balance was 7 trillion yuan when Xi Jinping took office. The debt has increased almost 9 times since then, with GDP and fiscal revenue not growing at a similar rate. This is a worrying trend as the ability to repay the debt is decreasing while the debt continues to rise. Local governments have been heavily reliant on land sales revenue over the past 3 years, which has been decreasing at a rate of over 30% annually, exacerbating the debt problem. If left unchecked, the increasing debt and the declining ability to repay could result in local debt collapse. The recent plea for help from Guizhou province shows that they are already unable to cope with their debt problems and have resorted to seeking assistance from the central government. This is the first case, and it is likely that other provinces will follow suit and sound the alarm soon. It is understandable why officials from the National Bureau of Statistics had a hard time justifying the 4.5% GDP growth data. Most of the structural data does not support this growth figure. A lot of individuals distrust the economic data that the CCP releases, as well as any data that the CCP publishes. They simply dismiss CCP data as fake. However, if you conduct a detailed and structural analysis of the CCP's data, you can still observe some genuine aspects of China's economy. Thank you for watching. Please leave a comment and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.